Hi, good morning, everyone. Today we have with us Ms. Valbha Shakya, who has done her master's from Delhi School of Economics. Currently, she is an assistant professor with Bhagat Singh College and is also doing her PhD from JNU. Welcome, Valbha.
Thank you, Arzu.
So, one of the most interesting topics that we have these days is what is happening with the increasing repo rate that RBI is continuously focusing on. As you would know, that repo rate is one of the most important monetary policy tools that is used by any central bank. So today's topic is about how RBI is going ahead and using this repo rate and what is going to be its impact on the Indian economy. So to begin with, I would like to understand for our students that many of them are confused between what is repo rate and what is reverse repo rate and what is the difference between the two. Could you please help us understand that?
Okay, so first of all, what is repo rate? So repo rate is basically a rate of interest that RBI charges whenever commercial bank. So these are scheduled commercial banks. These could be private banks as well as public sector banks. They are borrowing money from Reserve Bank of India. So first, let us know why they are borrowing money from Reserve Bank of India. So we know that every scheduled commercial bank, whether it is a public or private sector bank, they have certain limits. So at the end of the day, they have to meet certain liquidity requirements. That is, they need to have certain liquid reserves with them, and they have to meet them. So if they have a shortfall in this money, the liquid money, they can borrow that money from either the interbank call money market rate or the RBI to meet that shortfall. Or they have some other credit requirements that if they want to give loan to people or give loan to businesses or something like that, so they will be borrowing money from the Reserve Bank of India if they are having this shortfall in liquidity. So the repo rate is the rate which RBI will charge from these scheduled commercial bank if they are going to borrow money from the Reserve Bank of India. Okay, so this is the repo rate. Now let us come to the other scenario, that at the end of the day, it might be the case that the banks are left with excess liquidity. That is, they have more than money, more than cash deposits, which they more than that what which they require. So in this case, since these banks are profit making entities, they would not like to lie their funds idle. So they try to earn some rate of interest on these funds, these excess liquidity. So in this case, again, RBI gives them provision that if you have excess liquidity, you can park your money with us, and then we'll be paying some rate of interest on you. So the money which this commercial bank are giving to the RBI, the rate of interest which RBI will pay to them is called the reverse repo rate. So repo rate is the rate which RBI is going to charge them when the commercial banks are going to take a loan. And reverse repo rate, we can say that RBI is taking a loan from the commercial bank, and reverse repo rate is the rate of interest which RBI is charging. Okay. So RBI uses a tool which is called liquidity adjustment facility. So this repo rate and reverse repo rate comes under that. And it is generally seen that repo rate is always higher than reverse repo rate. So earlier the difference used to be around 1%, but now the difference has reduced. Okay.
Great. So it is like we going and borrowing from the commercial bank versus we going and depositing with the commercial bank. Can we say that also?
Yeah.
Great. Okay. So now that we know what these two rates are, we know that the repo rate has been continuously increasing. Is it going to impact the Indian economy? And if yes, then how is it going to impact the Indian economy?
Okay. So yes, increase in repo rate has a direct impact on the Indian economy, and that is why the Reserve Bank of India uses it as a monetary policy tool. So first of all, let us see that why the Reserve Bank of India needs to increase this repo rate. So repo rate, as we have seen, that it is a measure to manage the liquidity of the economy. So whenever there is inflation, we know there is high increase in price of the goods and services which people are consuming. So in case of inflation, what it means that there is too much liquidity in the money, or in simple economic terms, we can say that there are too few goods in the economy, but there is too much money in the economy and people are buying too few goods with too much money. So ultimately, this will lead to increase in prices. So this is where the repo rate comes in as a policy tool. So what RBI does is that if they are going to increase the repo rate, then this means that the opportunity cost for borrowing money for the commercial bank has increased. That is the rate at which they were taking or they were borrowing money from the commercial bank for their own use, that has increased. So this will then discourage the commercial bank to take loan from the Reserve Bank of India. And if the commercial bank is having less money with them, that means their activity is also going to reduce. So what is the activity of commercial bank? They mainly give out loans. So these loans are of various nature, whether it is a car loan or education loan or house loan or loan for investment or something like this. So if their opportunity cost of borrowing money from the Reserve Bank of India has increased, what they will do, they will also charge a higher rate of interest on borrowings or on the loans which they are giving to the people. So this is how it affects the Indian economy. That is, now people will have to pay a higher rate of interest for this money which they are going to borrow, and this discourages investors. So what happens is that now generally these loans are for some kind of investment. So this investment falls, and we have seen the national income identity, that if the investment will fall, this will have a direct impact on the output of the economy. So that is why whenever there is inflation, we say that there will be increase in repo rate by the Reserve Bank of India, and then there will be inflation, which will lead to stagnation, basically declining output, and at the same time there is inflation. So stagnation will be there, inflation will be there, output growth will be less, unemployment will be high. So this is how the Indian economy is affected in case of increase in repo rate.
Right.
But again, further, since we have this repo rate as a tool to control inflation, so with some amount of time we see that there is decline in liquidity in the economy and there is decline in demand. So demand will match the supply, and there will ultimately the prices start declining, and we can say that RBI is to some extent able to control this inflation. So this,
Absolutely. Exactly. That was going to be my next question. So we are mentioning that inflation would increase and decrease. So in the long run, what exactly is its impact on the consumer price index or any other price index? Are we expecting that increasing repo rates would increase the price indexes in the long run, or would it decrease them? So would it be a tool to maybe reduce inflation in the long run, or is it just going to lead to higher and higher inflation?
no, so ultimately, increase in repo rate will lead to fall in consumer price index in the long run. So this is what the Monetary Policy Committee does. This is what their operation is. They are now starting. They have started with this inflation targeting. So what they have is, they say that we should be having certain rate of inflation. So right now they have a benchmark inflation of 4%, and they have given a tolerance limit of plus minus 2%. So basically they are saying that if the inflation is somewhere between 2% to 6%, we are okay with it, we are fine with it. But if the inflation increases beyond this limit, then this is going to be problematic, and then we need to work on it. So if we see this current year 2022, which is going to end, inflation has been around 7.5 to 8%, and in this last quarter it has started declining. And at the same time, if you go and look at the Reserve Bank of India's policy rate, the repo rate, it has been continuously increased. So this is, I believe, the result of continuous increase in the repo rate, which has led to fall in this inflation. And it will affect both. So basically, we measure two types of inflation. One is the consumer price index, and the other is wholesale price index. So consumer price index is basically the basket of all goods and services which people are going to consume, and this is what is of more concern to the policymakers, because they want to see how the macroeconomic variables are going to affect the common people. And again, in that, again, we divide this inflation into two categories. One is called the headline inflation and the other is called core inflation. So headline inflation is when we are measuring or when we are taking into account the volatile goods, which are food and fuel things. And core inflation is when we exclude this food and fuel prices. So the inflation which we are having right now is more in categories of food and fuel, and that is why we are having so much of inflation. So that is why when targeting the inflation, headline CPI is used by the Reserve Bank of India to target the inflation, and this repo rate is changed, whether it is increased or decreased is based on this headline CPI. So we can say that initially this inflation will increase, but in the long term, this inflation is definitely going to decrease.
Correct. So I think this explains a lot to our audience. One last thing that, people are always interested in, how is it going to impact the real consumers who have actually gone ahead and taken loans from the bank? So for example, I myself took a loan in 2018 or 19, and we see that the interest rate are absolutely shooting upwards. How does it impact the real, the retail consumers who are taking loan?
Yeah. So again, there is this chain reaction kind of thing happening. So if there is an increase in repo rate, that means the cost of borrowing money for commercial bank has increased. Okay, so they are the middlemen kind of thing, and we are borrowing from these commercial banks. So if their cost of borrowing money has increased due to increase in repo rate, they are definitely going to charge higher rate of interest from us. Okay, so that is why whenever the repo rate is increased, the cost of borrowing money for people like us, that is our rate of interest on loans, also increases. So this is why, because the commercial bank are now getting this credit at a higher cost. So that is why they are charging from us a higher cost from our borrowings. So this is for fresh loans. Now coming to the loans which were taken earlier. So again, the EMIs on those loans is going to increase, because we see that most of these loans are now they have flexible rate of interest. So again, this flexible rate of interest is directly tied to the increase or decrease in repo rate. So whenever this repo rate will increase, these commercial banks are going to increase their lending rate, and we, the retail customers, will have to pay a higher rate of interest on our borrowings. So yeah, will have to pay a higher rate of interest if the repo rate continues to increase.
Absolutely. But in the long run, as we mentioned, that inflation targeting is going to take place.
Yeah.
So fingers crossed, we will have a lower real interest rate in the long run.
Yeah, fingers crossed. Because the inflation, even the retail inflation has started declining. So we hope that for the next policy, whenever this next policy meeting takes place, they will either keep the repo rate unchanged, or they might reduce it, not increase it.
Right. Yes. Thank you. So I think so, Valbha, it was a great session, and it did give our audience a view about what repo rate is and how it is going to impact the Indian economy in the long run. Thank you so much for your valuable time, and we really appreciate it.
Thank you.